All right, good morning, everybody. Can you guys hear me? Okay. So really excited about this panel. We've had a lot of fun already talking about what we're going to talk about on the panel, but I'd like to kind of start by sort of echoing what President Harker said in his opening remarks. When we talk about digital asset strategies in banks, the two goals are operational efficiencies for institutions and tangible benefits for customers. So my first question, starting with you, Caroline, is how do you think about those two goals as you're working on various initiatives at BNY?
So when I think about our ambition in this space, it's really to be the lead provider for secure, innovative, and client-centric solutions across digital assets, and very importantly, across the entire investment lifecycle. So the opportunity, particularly with this new technology, is to interconnect lots of disparate capabilities within banks and across the entire ecosystem. I think that's very important, but to do it in a very prudent way. We believe that in Bank of New York, we have quite a unique opportunity because we have a lot of significance in the ecosystem. We have very, very deep client relationships, Franklin obviously being one of those core clients for us. And we have a culture and I would say a legacy of innovation. We turned 240 years old this year, not me, the company. And it is a real testament to our resiliency. And the word you didn't use there was resiliency. And I think that's embedded in that message as well. And I don't think you get to be resilient and survive 240 years unless you can innovate. But very importantly, innovate on behalf of clients and innovate in a very measured and prudent way. And in terms of our depth, we actually had another milestone this week that I'll mention very quickly. We got over $50 trillion of assets under custody. So that is not a small number. It's an industry first. We've 2 trillion assets under management in the company. We touch 20% of the world's investable assets. So that breadth and depth really gives us a perspective, number one. So when we're innovating using the newest and latest technologies, we have a lot of perspective. But very importantly, it gives us an obligation to make sure that we're doing that in a very prudent way. So for digital assets, it's just that next evolution of taking a new technology, taking the paper ledger that Alexander Hamilton has. He was the founder of the bank. We do have the paper ledger in our headquarters. Sandy, I think you've seen it. And it's a beautiful reminder of technology evolves, slower in the beginning, faster now, and we're there to make sure that we evolve it for clients in a prudent way.
Before I come to you, Sandy, Caroline, could you just maybe to help the audience understand, like, what are like the one or two or initiatives related to digital assets that you're most proud of, that BNY kind of has furthest along?
So we've got a number of things. So at the kind of core of our philosophy and our framework for digital assets is just do what we do today for clients for this new asset type, this new market, or this new client type. And I think that's an important philosophy. So we brought digital asset custody into the market in 2022. We did have a few limitations in our ability to scale it. Those limitations are starting to be removed. We were subjected to SAB 121. We've recently just received an exemption from SAB for ETPs. We are servicing over 80% of crypto ETPs, Franklin being one of our clients, so we're offering fund services. So again, offering a lot of our traditional services to the new asset class or to the new marketplace or to the new client types. We do payment services as well. And very importantly, how we're bringing those, what are perceived to be rather traditional services. I mean, custody is custody. We're doing it in a way we're applying all of the institutional grade standards that we have in our custody business and the different services that we bring to bear. But we're also bringing that technology into our operating models in a much different way. So we're not just doing it incrementally better, we're actually taking the opportunity to truly redesign how we bring services to market. So digital transfer agency, which is effectively record keeping, it's ownership. So go back and think about, what is Bank of New York? Much of what we do is just a ledger business, plus a lot of services that we enable on top of that. So being able to offer digital ledgers it's sort of an imperative that we fill. So having a digital ownership through transfer agency is another offering that we are looking to bring to market as well. And I could go on. So it's really looking at all of the traditional services and doing them in digital form.
All right, great, thank you. And Sandy, sorry for keeping you waiting for so long, but same question. We'd love to hear kind of how you're thinking about those dual aims at Franklin Templeton.
Yeah, so I think that where I always start in thinking about what is our strategy here is that we have to recognize that today's financial market infrastructure is over 50 years old. And though we've improved the memory and we've improved the processing speed, we really have not re-examined the processes we use to settle and to clear transactions. And that's really beginning to show up as a real shortfall in the marketplace when you compare it to some of the new technologies that are coming out, right? So our number one focus at Franklin Templeton has been to say that the potential of the new technologies and the ability to use these new technologies to enhance our operations and to extend our investment opportunities has to be first and foremost, right? So to the point Carolyn made, processing, how we process transactions, how we keep records, that has been beginning to fundamentally change. And Franklin Templeton was one of the first firms to really build the infrastructure needed to test this hypothesis. So we actually built our own transfer agency system that operates on public blockchain. We built our own wallet system in coordination with the SEC to meet KYC AML requirements. And we deployed this system initially on one public blockchain, and we have since been able to extend that deployment across 6 different public blockchains. And what this has taught us is that, number one, you can process trades much more quickly, right? We realized nearly a 50x cut in the cost of processing a trade by moving it onto the public blockchain. Number two, we recognized that you can take actions at much more frequent intervals that are going to be very beneficial to clients, right? Today, because it takes at a minimum 1 day to settle even an equity trade, and we just got to 1 day this year, right? That means that the payments that get paid out on any kind of fund, such as a money market fund, only happen 1 time per day, and it's usually the next day, shareholders of record at the start of the next trading session. So what you're able to do by being able to process these trades on public blockchains is treat each block that gets settled as the start of a new day. So you can actually start to facilitate intraday awards to consumers, which will really benefit customers in terms of getting the full benefit of the trades that they have on and put on. So there's a tremendous number of operational improvements that we've been able to achieve using these new rails. And we're a partner in many ways in exploring these new capabilities with Bank of New York Mellon. Bank of New York, sorry, drop the Mellon now. Bank of New York. And what we are also looking at, though, is in building these technologies, we are first and foremost an asset manager. And in building these technologies, we realized that amazing opportunities are there for consumers to take advantage of. This is the biggest set of innovations that we have seen in the technology space in probably 50 years since the launch of computing, right? And instead of a company offering these improvements where I can go and buy the equity or buy the debt of the company, we realized that these are open source protocols that are building these capabilities in most instances, and that we have developed the research capability, the trading capability, and the fund construction, portfolio construction capability to be able to provide our clients exposure to these new protocols in their investment portfolios, which we think really are representing the next generation of tech opportunities. So we've both pursued the operational efficiency side, Steve, and we're very much looking at the investment side of these equations. And we're looking at the new use cases that are being unlocked because of the technologies. One of the key areas, we have already over now 500 million in our tokenized government money market fund. And we're finding new use cases for this every day within the financial ecosystem because being able to have a tokenized money market fund allows us to increase the velocity of trade movements in a secure and well-regulated way. It allows us to use this money-like instrument in new ways to facilitate collateralization within the ecosystem. And it opens up an opportunity to facilitate easier cross-border use of payments because we can use this money market fund in conjunction with stable coins as new transport rails for payments around the globe. So we're opening up new use cases in traditional instruments as well.
I've been told that one area that you both disagree on is on the public versus the private debate when it comes to blockchains. I assume everyone here probably knows what that is. But Sandy, I know you're a big proponent of building on public. My sense is you think that's the only way to do this. Carolyn, I know that you have a slightly more nuanced perspective. So maybe you could start by giving us your side of things first.
So first off, we support both private and public chains because our clients do. So first and foremost, we are there to serve our clients. But I always go back to basics, right? I used to run custody for a number of years. And the same way that there's certain markets that we won't offer custody in because we simply cannot prove out the security of that market and we cannot keep those assets safe. It's the same way that certain types of assets and digital assets or certain types of chains, we may not be able to perform the services to the standards that we would expect and our clients would expect and our regulators would expect. So there's nuance in that. But
if I may, what are some of the things that you look for that may invalidate a blockchain?
So again, it's privacy, security, the ability to know who the actors are. So KYC is very important. I do think there is nuances of whether private or public is more or less secure. I think there's a misperception that private networks are more secure because there is known parties. But again, then you've got an actual risk with those entities that could be in some ways a risk that you don't want to take. So there's a lot of nuances. The fortune we have, because of the diversity of our client base, is we actually are offering services across public and private chains. So whether it is supporting the tokenization of money market funds, like Sandy mentioned, many of those are on public chains. Some are on private chains. We're also supporting tokenized bonds on public and private chains. So we have the fortune of seeing both. I think there's still a lot of growth and maturing of the underlying technologies, and I hope that at some point in the not too distant future, Sandy and I will sit together on stage and not have to talk about the base infrastructure because the market will have moved and matured so much that we'll be talking about the value that we can create on top of a stable infrastructure.
Yeah, it's funny. I was at a conference a couple of years ago, and I think one of the questions was, it was related to databases or something, and the question was, what do you look forward to in 5 years? Like not having a conference with the word blockchain in it ever again, because it's just taken as a given. Sandy, what are your thoughts?
So, first off, we also interact with both private and public blockchains, right? We have chosen to build on public blockchains, but that is because we believe this will be the end state, and we want to have experience with this plumbing and be able to embed our offerings into this new ecosystem. We truly believe that public blockchains are going to become global utilities where all record keeping is going to move. But that's a vision that's for the future. In the short term, regulators have not yet created the pathway for us to be, as an industry, widely using public blockchains. Many of them still are using whitelisting as opposed to having true KYC AML. Many of them are still working through some security concerns. And so there are risks in working in public blockchains. We actually have a very strict set of criteria we use at Franklin Templeton to evaluate a public blockchain to see if it meets the standards that we need of both decentralization and security and throughput. But what I have seen play out many times, because now I'm old, Steve, and I've been in the industry for almost 40 years, what I have seen play out over and over is that we do not want to fragment liquidity. And this is the biggest risk in private blockchains. One bank has its private blockchain, another bank has its private blockchain, another nation has its private blockchain, this set of central banks have their private blockchain, and all of a sudden global liquidity is fragmented. And we saw with the emergence of alternative trading systems the issues that came up when we fragment liquidity. It created more opportunities for there to be illegal or unwanted actions. It created more inefficiencies that hurt consumers in the end run because it affected pricing. And we had to put in a whole slew of regulations to be able to ensure that this fragmentation of liquidity did not result in imbalances in the system. So our biggest issue with private blockchains is simply that we do not believe they're going to ever be able to contain sufficient liquidity to really allow for an efficient system, particularly not when there are benefits to working in these public blockchains where thousands of developers are constantly focused, constantly being given bug bounties to try and find errors in the code or vulnerabilities. We think that that's just going to end up being a much more secure and much more affordable and much more transparent ecosystem that can aggregate liquidity.
Yeah, Caroline, so related to the private blockchains, I mean, liquidity silos are big concerns, but they also come with additional customization features, the ability to know who's participating on the network. How do you weigh those two areas?
So one of the things that Sandy talked about was when you've created these private, call them ecosystems, right? And when they're not interoperable amongst each other, you then have one of two things that happen. You either have dominance and fragmentation, like Sandy mentioned, or you have the birth of all of these interoperability players who often come in the form of fintechs and younger, newer companies that create a concentration risk that I think we need to watch out for. The underlying technology is by definition interoperable, right? It allows us to enable interoperability across the assets, across the use cases, across the globe, across the different players. So for us, making sure that we have digital forms of ID and implicit in how we do things and not focus on this creation of a synthetic layer of interoperability gives us the opportunity to really see who is behaving in what way and doing what. Sandy and I talk about this a lot. The beauty of the technology, you can actually see things in real time above and beyond anything that we can do in the traditional space. You can do KYC in theory on a transaction basis, not after the fact. And I think that's a super empowering thing for the future, for us to be able to actually keep our clients' assets safe and be able to mobilize those assets, create greater utility for assets. Sandy mentioned collateral. I mean, I think that is one of the great promises that we can actually enact rather fast if we're able to really have certainty of who's performing what activities on the chain. So I think digital ID doesn't get talked about enough, but I think there needs to be a lot more progress on how we can actually implement that as a basis for how we can protect customers' assets in the future.
And Sandy, related to open blockchains, interoperability, I understand everything you're saying, but you know as well as I do that blockchains can be tribal, and now we have base blockchains, we have layer 2s, we have layer 3s, and so on and so forth. And inevitably, liquidity will get locked up in these different chains, and people don't always want to move it from one to another. This may be a little bit further afield from where Franklin Templeton is now, but I'm sure you're thinking about it. Like what is your strategy to make sure that your use of public blockchains remains interoperable and the most liquidity possible for users?
Yeah, so that's a great question, Steve. So to be very clear, the way that we have deployed our system across the public blockchains is that we have a wallet for each person on each blockchain that is internalized to Franklin Templeton's own control, right? So there would be a Steve wallet on each of the 6 blockchains that we're on. And if you wanted to move liquidity between blockchains, we would move your assets inside our walled garden where we have full control and full KYC AML and full ability to recreate tokens if there were to ever be any loss of your tokens that you hold, because we have the shareholder ledger, right? So we have created a way of internalizing cross-blockchain activities that do not expose the customer to any sort of external threats. But over time, I have to completely agree with Carolyn. I think our entire approach today to KYC AML is foundationally broken in this industry. We force every firm to perform their own KYC AML instead of using a centralized database with the latest information available from any firm. We look at this as something that has to take place and be checked on every transaction, even though once we have KYC'd AML to person, there's no reason that we can't passport them. And there are starting to be more and more digital identity solutions that are being created, such as soul-bound tokens that would allow my digital identity to move with any transaction I do. So I do think that we need to take a step back and think about the capabilities of these new technologies and really think about, is there a much better way to be doing what we do today? Carolyn said that's kind of the guiding principle at Bank of New York, is can they use the technology to do what they do today better? That's what we're finding at Franklin Templeton. There's a lot of opportunities here, and because people are somehow frightened by this technology or concerned about how different it is from the technologies of the past, we are missing out on these opportunities as an industry. And we are missing out on them more in the United States than in any other country in the world, because we are really not embracing the opportunity. We're only embracing the parts of the system that create concern. Rather than mitigating the concerns, we've used those concerns to justify not interacting with the system, and that's not going to be a sustainable strategy.
I have one or two more questions. I think we want to leave time for audience Q&A, Jalapa, as well, or no? Okay. All right, no questions. So one of the things I admire about both of you is that you've been in the industry for a long time. You and I, Sandy, have been in the industry long enough to have both been laughed at by Citibank when we were working there in 2017. I'm interested in just, there's this big overhang of risk related to blockchains because for a lot of reasons, security, you don't know who's on it. You've both been sort of pioneering the integration of this in traditional finance for years. And I'd love to just get your sense of, like, what are the best strategies to get buy-in from senior risk averse executives and yeah, I mean, just really, what have you learned? Because tokenization's been around for almost 10 years at this point. The idea of blockchains, I mean, they've been around for 15 years, and we're still looking, there's a lot of promising developments, but we're still looking, I believe, for that big mainstream breakthrough moment. But how do you keep that going so that you can reach that point?
So the words that come into my mind, emotional resilience. I think you said tokenization's been around for a long time. Do you know how long we've been tokenizing in Bank of New York?
No.
Take a guess. This is unfair. 90 years.
90.
Because depository receipts are the first tokenized assets, right? So when depository receipts came out and we're number one DR bank, I'm sure there was a lot of trepidation. I remember ETFs. I was one of the first ones on the as an AP in the ETF industry, and they were seen as a crazy fad at the time. So I think there's always this trepidation with anything new. Number one, it's educate and go back to basic principles and facts, and doing that education over and over and over and over again. Second is, we're not alone. And I think Sandy and I and our companies can attest to this. The collaboration and the cooperation before we compete is super, super important. I think the difference now between technologies that have popped up in the last, call it 10 years or so, it's the speed at which they're going to move is exponentially faster than we would have seen the paper to computer era. That took decades and decades. Now we're starting to see new technologies come in, and those hit use cases and the market much faster. And then there's the global nature of it. So I think that constant education, going back to baseline principles, we always look in BMY, we look at the facts and principles first and foremost. And if you've got those fact patterns laid out, any new technology, you just get very suspicious on what could go wrong. And I think that's the other fortune when you are a systemically important bank. We wake up every day assuming every single thing is going to go wrong at every single minute in the day. And you plan for that, right? And obviously there's going to be a lot of unknown unknowns. I think the world of this technology is an unknown unknown. I think there's a huge disruption it can have. And I think it's been prepared for that. We're in the preparedness business, and we need to be out in front of that at all times. And just that constant dialogue and education, it sounds trivial, but it's absolutely imperative.
Same question.
Yeah, I think it's also ask people common sense questions. If I said to you, there's a way that we could free up 100 billion in collateral annually in the ecosystem, and that money could be deployed in ways that could benefit underlying consumers, that seems like a pretty strong business case to consider how we might do that. If I say to you, there's a way that we can eliminate many of the market-related risks by moving to 24/7, 365 markets, there's a benefit to doing that, right? We are looking at this idea that, we may be left behind from a geopolitical risk perspective because our competitors, peer nations and competitive nations, are creating new networks and ecosystems that the United States is not choosing to participate in. That does not seem like a smart strategy. We can't put our heads in the sands about technology. Technology is constantly going to change. You guys think blockchain and the crypto technologies are hard? Wait till quantum comes of age in the next 5 years, right? The technology is always going to challenge us, but we need to challenge ourselves back and say we are in the financial services industry, the most innovative industry in the world in terms of adapting new technology to make a system stronger for consumers and investors, and we need to think about, how do we make that case over and over each time the technology changes? And I think going back to what it brings in terms of benefit to the system is the way to make those arguments.
I think we have time for maybe one or two more questions. I wanted to ask about your thoughts on CBDCs versus stablecoins and how that might fit into all of this. The best unkept secret in the world is that most money is already digital, but stablecoins are a $170 billion business. It's growing, albeit most of it, I believe, is used for trading. CBDCs, central banks around the world, are at the very least researching it. Many are testing. How do you think about that when you're conceptualizing these ideas, and how do you work some of these products into your trials to make sure that you can be integrated with central banks around the world? Caroline, you can go first.
So when we think about digital money in general, there's first and foremost the kind of need to move money fast. Okay, so we talked about FedNow and the great benefits FedNow has produced for us. And in a lot of cases, you don't even need blockchain for that, right? You can move money globally and you can move it faster. When you talk about digital assets, though, you need some form of on-chain cash or on-chain money to be able to move those assets faster. Again, a lot of the benefits that Sandy's talked about in terms of collateral, it's all about mobility of assets and global mobility of those assets. There's a lot of different ways you could do that. Sandy mentioned money market funds, right? Money market funds as a form of digital money over time could be a potential as well. So for us, when we look at our client base and the innovations that they're coming up with, we have stablecoins. We manage Circle's Reserve. So we have a lot of different touch points with different forms of whether it's stablecoins, CBDCs, bank deposit tokens. Our view strongly is that it needs to be across the ecosystem. We don't believe in having a closed wall solution for digital money because it goes against the premise of the benefits that we're trying to have. So we're in collaboration with Monetary Authority of Singapore and a number of different commercial banks to create a global layer 1 to enable a digital form of money and assets. We're part of Project Agora, which is the BIS-led initiative. So we feel that philosophically, we really need to be powering a lot of these collaborations across the ecosystem, whatever form that digital cash takes, whether it is wholesale CBDCs over time, or whether it is different forms of stable coins that are interoperable across the entire ecosystem.
Thanks. That's Sandy.
So we have 1 minute, so I'll go quickly. There's going to be multiple forms of money and money-like instruments that we are going to deal with in very short order. I don't even think we have 5 years in this regard, right? You need to understand with the transparency, with the velocity of movement, and with the ability to verify holdings in digital wallets, we are going to really see the reemergence of what we're calling a high-tech barter society. There's no reason why I can't use tokenized gold, tokenized diamonds, just as well as I can use tokenized money market funds or CBDCs or stable coins to make payments, right? And this is something that sitting here at the Fed, we're going to have to deal with and think about, because everything is going to be able to potentially be used as a form of payment in the future, a store of value and a form of exchange. And therefore, we need to think about what does that world look like and how do we control it when there's so many substitutes to potential forms of money, and CBDCs and stablecoins are just the tip of that arrow.
I like that idea, the high-tech barter society. I might make that my next story. With that, I'd like to thank our panelists. I'd like to thank everyone for attending, Jalop and the Philly Fed for having us, and enjoy the rest of your day.